So I know every month you compile these different data points. Some of them you consider leading indicators. Others are a little bit more trailing and lagging indicators. But let's start with the leading ones. And I want to caveat or preempt all of this with a statement that it seems like there's a lot of volatility in terms of what signals are actually indicating about this economy. But what did you find for the leading indicators for the month of March?
Yeah, that's exactly it, is that there's a lot of churn in these numbers, especially for the last few months. And I mean, I don't know if that's a signal of a top or if a signal of change, but I think that when you look at the actual numbers in the economy, they're a little more clear-cut in some ways than what our indicators are saying. For the leading indicators, we saw new orders for consumer goods and manufacturers, new orders for non-defense goods growing, and we also saw that in GDP somewhat. We saw a very small increase in brokerage accounts. That's another leading indicator, and a tiny change in the U.S. yield spread. But I think what's more important is that we're seeing some declines in some areas. For example, the consumer expectations index. New housing starts, and we already know that housing is and residential investment is plummeting. All that sort of thing. So I think GDP, which we got yesterday morning, of course, U.S. first quarter GDP actually helped to clarify the business conditions monthly more than the other way around.
Peter, were any of the measurements that you guys took for the month of March post Silicon Valley Bank collapse, and if so, or in either case, do you have any data that's indicating economic conditions or specifically credit conditions tightening post collapse?
Yeah. So most of the measurements. So we're always looking at the previous month. So the April release, which we had a few days ago, was for March of 2023, and we didn't see many signs of the credit tightening. I think those took a little bit to settle in, but we definitely see them now.
You do.
Yeah, absolutely. I mean, it's almost as if the effects of the collapse of Silicon Valley Bank and Signature Bank had an effect of almost like another Fed tightening, like another 25 basis points. And you can see that a little bit in credit spreads, but you can certainly see it in falling applications or whether it's applications for approvals, falling availability of loans.
Yeah. Peter, what do you make of, and what does the AIER in general make of the yield curve inversion? So, I mean, it honestly hasn't been talked about because it's been inverted for so long now, but you guys have data going back in terms of what that means for its predictability on a recession. What's your takeaway on the inverted yield curve right now and what we should make of it?
So I am one of those people who believes that the yield curve inversions are well, there's a lot to say. I mean, first of all, they are not as predictive as people say because very frequently there's a lag time, and it could be sometimes up to 2 years after an inversion where you see a slowdown in the economy. And also, we've had at least 2 yield curve inversions that didn't result in a recession. Right now, I mean, so I looked at 3 of these in our recent report, and one of them, which is the sort of the favorite of the Federal Reserve, which is the 3-month to 18-month yield curve inversion. That one, historically, at its levels right now, would say a 93% of a chance of a recession in the next 12 months. But the thing is, it's right now the widest it's ever been. So, I mean, you would have been making this call over a year ago if you'd been following it strictly. So they're kind of a flawed indicator. I found 4 others that I think are a little more telling of the current situation.
Peter, any other specific items in the report that you looked at and said, wow, this is a clear indicator of the economy either heating up or slowing down or inflation going in one direction or another?
Yeah, I mean, inflation's very sticky, but I think the thing that really sort of blew me away yesterday was the explosion in unsold inventories. It's probably the biggest number that I ever remember seeing. It's like $138 billion worth of unsold inventory, and I think that is both a consequence of and also sort of a cause of rapidly declining business confidence, rapidly declining firm manager and optimism, and lack of firm investment, lack of capital investment. Those bode very poorly for the next 12 months.
Peter Earle, he's from the American Institute of Economic Research, joining us today to talk about the business conditions report for the month of March 2023. Peter, thanks so much for joining us. Appreciate it, and talk to you next month.
Thanks for having me.